Welcome to another episode of the Retirepreneur Podcast. I'm your host with this week's executive summary for busy entrepreneurs building their second act business. Today's episode is designed for maximum impact in minimum time.
Right, getting straight to the good stuff.
Exactly. So today we are doing a really interesting deep dive into a pretty fascinating paradox. Why is it that the corporate world might, pass you over for a promotion at age 60, but a smart CEO will happily pay you triple your old salary as an independent consultant to solve the exact same problems?
It is a massive shift in perspective. And frankly, it is the secret weapon for professionals who are entering the later stages of their careers.
Right.
I mean, a corporate ladder might stall out for you, but the independent market, they actually value that experience at an absolute premium.
Yeah, and that is exactly what we are focusing on today. So if you are listening right now, maybe you are on your commute or just getting a walk in, we are cutting straight to the core of some incredible research from the Retirepreneur platform.
It is such a great resource, by the way.
It really is. It was founded by Kurt Rose, and the platform has one very specific mission. They help professionals aged 55 and older take, decades of expertise and turn it into new businesses.
Right, but doing it safely.
Exactly.
Yeah.
They show you how to do it without risking your hard-earned retirement security.
And that last part, that is just critical. When we talk about starting a business later in life, we are absolutely not talking about draining your 401k to fund some speculative app idea.
Oh, definitely not.
Right. We are talking about highly calculated, low-risk business models that are designed specifically for experienced professionals.
Yeah, so our goal today is to extract the 3 most actionable insights from Kurt Rose's material. We're going to look at why consulting is mathematically the smartest vehicle to choose, then how to price your outcomes so you never sell yourself short. And finally, we'll look at the hidden tax and Medicare traps that, they catch a lot of first-time consultants completely off guard.
They never do. It happens all the time.
So let's get into it. The source material makes a pretty bold claim right up front. It argues that consulting is practically and mathematically the ultimate second act business for anyone over 55.
Yeah, it really makes a strong case for it.
So why is consulting so superior to, all the other options out there?
Well, it basically boils down to 2 vital resources that you have to measure really carefully at this stage of life, and that is time and capital.
Right. You don't want to waste either of those.
Exactly. So consulting requires 0 startup capital. You do not need a business loan. You do not need to buy inventory.
You just need your brain.
Right. You are simply monetizing the intellectual property that already exists in your head. And because of that, you can generate actual revenue in something like 4 to 6 weeks.
Wow, just 4 to 6 weeks. When you put it that way, the contrast with other popular business models is pretty stark.
Yeah.
Because we constantly see franchises being marketed to this demographic as, a really safe retirement business.
Oh, yeah. Franchises are actually a perfect example of what to avoid if you want a fast, low-risk start.
Hey, really?
Yeah. A typical franchise requires an average upfront cash investment of $150,000 or more.
Geez, that's a lot of cash to lock up.
It is. And then you already know the realities of commercial leases and trying to hire staff. But the real killer there is the timeline. You are looking at 12 to 18 months before you see your first real dollar of profit.
Wow.
Yeah. So that is a massive capital risk and a huge time lockup, especially when you are in your late 50s or 60s.
Right. That makes total sense. But then you have the other extreme, right? The whole digital product world.
Yeah.
Because everyone online tells you to build a course or start a paid internet community.
Exactly. And, while an online course might have low financial startup costs, it requires 6 to 12 months of grueling, isolated work to build before you make a dime.
And you don't even know if anyone wants it.
Right. That is the worst part, the blind risk. There is absolutely no guarantee the market actually wants what you just spent a whole year building.
Yeah, that sounds incredibly frustrating.
It is. But consulting acts as an immediate validation layer. You get paid right now to solve urgent problems, which tells you exactly what the market values.
Oh, that is smart.
Yeah. In fact, the Retirepreneur platform emphasizes that a lot of professionals use their initial consulting income to fund and test whatever digital products they decide to build later on.
Okay, so the vehicle is low risk and it generates cash quickly.
Yeah.
But I want to address the elephant in the room here.
Sure.
A lot of older professionals harbor this quiet fear that their age is a liability. They look around and see a business culture that seems entirely obsessed with youth and disruption.
Yeah, that fear is super common. But the data and the actual market reality say the exact opposite.
Really?
Yes. Your age is actually a highly priceable competitive advantage. This is where we separate the amateurs from the true experts, honestly.
Okay, how so?
Well, younger consultants rely heavily on frameworks. They come in with a rigid playbook or maybe some trendy methodology they learned in a master's program.
Right.
But professionals 55 and older possess something infinitely more valuable, and that is pattern recognition.
Pattern recognition. I love thinking about it this way. Relying on a framework is, well, it's a lot like using a GPS.
Oh, that's a good way to look at it.
Yeah, like it works fine most of the time when conditions are perfect.
Right.
But having pattern recognition is like being the local driver who has driven those exact same roads for 30 years.
Exactly.
The GPS will completely fail if a bridge is unexpectedly closed. But the local driver, they know exactly which unmapped dirt road to take to just bypass the traffic entirely.
That is a perfect analogy, and the material actually provides a highly specific example of this in action.
Let's hear it.
So imagine a former chief financial officer who steps into a mid-sized regional manufacturing company, and the client is bleeding cash and struggling with their reporting.
Sounds stressful.
Very. Now, a younger consultant might spend 3 months running this massive data analysis project just to build a new dashboard.
Right, following the framework.
Exactly. But the former CFO just looks at the situation and recognizes the exact pattern instantly.
Because they have literally lived through that exact crisis 3 times before in their career.
Precisely. They do not need to run a 3-month study. They know the client needs a small business administration credit facility right now.
Oh, right.
Which is essentially a government-backed revolving line of credit. It injects immediate working capital without crippling interest rates.
Okay.
And the CFO knows the exact 3 moves required to restructure the cash flow and secure that facility in under 90 days.
The client does not care about the fancy dashboard at that point. I mean, they care about survival.
Exactly.
And that level of decisive action, you only get that from decades of reps.
You really do. And the data absolutely proves that this experience translates directly to business survival. The Kauffman Foundation, they track entrepreneurial trends, and they found that adults aged 55 to 64 were one of the fastest growing segments of new founders. They have a startup rate of 0.38%.
Wow. So how does that stack up against, the younger demographic that gets all the media attention?
It completely crushes them. The 20 to 34 demographic has a startup rate of just 0.22%.
That is huge difference.
Yeah. First-time founder applications from the older group actually rose 35% over the last decade. And once they start, they survive longer, too.
Really?
Yeah. According to SCORE, the first-year failure rate for 60-year-old business owners is 8.2%. But for 30-year-olds, it is 11.1%.
So the local driver beats the GPS almost every time.
Pretty much every time, yeah.
So experience wins, and consulting is clearly the right vehicle here.
Yeah.
But there is a massive gap between knowing you are a great driver and actually getting a passenger to pay you for the ride.
That is very true.
So how do you bridge that gap? I think this brings us to the concept of the precise offer and outcome pricing.
Yes. This is the exact moment where most corporate professionals tend to stumble. They leave their job, they decide to consult, and they immediately default to describing themselves using their old corporate resume.
Right. Like updating their LinkedIn to say they have 30 years in finance.
Exactly. Or they market themselves as a former human resources director who is available for fractional work.
And the material is very clear that this is a trap.
Yeah, absolutely a trap.
Because telling people what your title was for the last 30 years, that does not tell a CEO why they should write you a check today.
It tells them absolutely nothing about the value you bring to the table. You have to completely abandon the corporate resume.
Okay, so what do you do instead?
You have to be able to answer one hyper-specific question without hesitating. Who exactly do you help, and what specific problem do you solve?
Okay, let's make this real for the listener. Because if someone is listening right now thinking, well, I don't have a hyper-specific niche. I was just a general manager overseeing operations for 20 years. How do they find that specific offer?
You have to look for the fires you were consistently asked to put out over those years.
Oh, I like that. Look for the fires.
Yeah, the material gives a really great comparison here. Broad and ineffective is saying you are a former HR director who helps businesses with operational guidance.
Yeah, that sounds like everybody else.
Right. But specific and highly profitable is saying you are a former HR director who helps manufacturing companies manage large workforce reductions without triggering wrongful termination litigation.
Wow, that is incredible specific.
It has to be, because when you are that specific, the exact right client recognizes themselves immediately.
Right, they hear that and think, oh my gosh, that's us.
Exactly. They say, we are doing layoffs next month and we are terrified of getting sued, so we need to hire this person right now. Research confirms that this niche identification is literally the single most important early decision you will make.
Okay, so you nail down this hyper-specific offer. How do you actually get that first client? I mean, I think the immediate instinct for a lot of people leaving the corporate world is to go on LinkedIn and just start blasting cold pitch messages to hundreds of strangers.
Please do not do that. That is a massive waste of time and it hurts your credibility.
Yeah, it feels a bit spammy.
It really is. The data shows that 60% of first consulting clients come from direct network referrals.
60%.
Yes. Your first client almost certainly already knows you, or they are just 1 degree of separation away. You just need to activate your existing network.
Walk me through the actual mechanics of that. Let's say I identify 20 people in my network who work adjacent to my new niche.
Okay.
And I invite them to a virtual coffee. How do I steer a casual catch-up into a business-generating conversation without making it incredibly awkward or, sounding desperate for work?
Right. Nobody wants to sound desperate. The secret is that you are not asking them for a job. You're asking for their perspective.
Oh, that is a smart shift.
Yeah. You sit down with your former colleague and you say, look, I am officially launching my own practice. I am focusing entirely on helping mid-sized manufacturers handle layoffs without getting sued.
Okay.
And then you say, since you are so plugged into the manufacturing sector, I wanted to run my approach by you and see if you think this is a blind spot companies are actually worried about.
Ah, I see. So you were validating the business model with them, which naturally forces them to think about the problem.
Exactly. You bring them in as an advisor, essentially. And once they agree that it is a massive problem, you ask the final question.
Which is?
You do not ask if they want to hire you. You ask, who do you know in your circle who might be losing sleep over this exact issue right now?
That is brilliant. You make them a scout for your business.
Right. It removes all the pressure and completely preserves the relationship.
That is incredibly practical. I feel like one targeted conversation structured like that is worth more than 1,000 cold emails.
Easily.
But let's talk about the money, because this is where I want to push back hard.
Let's do it.
The material strongly advises against hourly billing. It says you should completely ignore your old corporate salary and pushes for value-based pricing.
Yes, very strongly.
But practically speaking, how do you keep a straight face when you are asking a client for a $25,000 lump sum for the first time, especially when your brain is hardwired to expect the safety of a biweekly paycheck? I mean, it sounds terrifying.
Oh, it is absolutely terrifying. The first few times you do it, the imposter syndrome hits really hard.
I can imagine.
Data actually shows that new consultants consistently undercharge, usually in the $50 to $100 an hour range, simply because asking for a large project fee feels presumptuous to them.
Right. You feel like you haven't earned it yet.
Exactly. But you have to look at the mathematics of selling a measurable solution instead of renting out your time.
Break the math down for us then. Why does hourly billing fail the experienced professional?
Because hourly billing punishes efficiency. Suppose you were brought in to solve a supply chain bottleneck that is costing a company $400,000 a year in wasted working capital.
Okay, a huge problem.
Right. If you charge $150 an hour and your pattern recognition is so sharp that you diagnose and fix the problem in just 10 hours, you only make $1,500.
Wow. You just saved the company $400,000 and you received a tiny fraction of a percent of that value.
Exactly. You literally penalized yourself for being fast and brilliant. That is why it is never a per-hour engagement. It is a $15,000 to $25,000 project fee.
Because of the value of the outcome.
Yes. The client is not paying for 10 hours of your time. They are paying to immediately stop a $400,000 bleed. When you price the outcome instead of the clock, $25,000 looks like an absolute bargain to the CEO.
That completely flips the script. You are selling the destination, not the plane ride.
I love that. Exactly.
And I assume this same logic applies if you want recurring revenue.
Yes, definitely. If you prefer ongoing advisory work, the material notes that monthly retainer structures typically run $3,000 to $5,000 a month for a handful of clients.
Okay.
And again, you are retained for your ongoing access and your pattern recognition, not a set number of hours.
All right, so you held your nerve, you asked for the $25,000, and the check cleared. You feel like a genius.
Best feeling in the world.
But then tax season hits, and you realize you walked right into a complex web of financial traps.
Oh, yeah.
Which brings us to our final point, the financial reality check.
This is the critical piece that catches highly successful new consultants completely off guard. When you leave the corporate umbrella, you also leave their payroll department behind.
Right. No one is doing the math for you anymore.
Exactly. You are now solely responsible for navigating taxes, Social Security thresholds, and Medicare surcharges.
Let's start with the immediate tax impact. Because you don't necessarily need to form an LLC on day one, right? You can operate as a sole proprietor just to get started. But the self-employment tax, that is unavoidable.
Right. When you are an employee, you split payroll taxes with your employer. But when you are a consultant, you pay both halves yourself.
Ouch.
Yeah, that is the self-employment tax. And it sits at 15.3%. For the year 2025, that applies to the first $168,600 of your net earnings.
That is a really significant chunk of change. If you do not factor an extra 15% into your value-based pricing right from the start, you are going to take a major hit to your actual take-home pay.
Exactly. You have to plan for it.
Yeah.
But honestly, the complications get much steeper when we look at retirement systems like Social Security.
Because they have earning limits.
Yes, very strict earning thresholds. If you decide to collect Social Security benefits before you reach your full retirement age, your new consulting income can actively reduce your benefit check.
Okay, what are the actual numbers on that threshold?
So for 2025, the annual earning limit is $22,320.
That is not very high if you are landing $25,000 projects.
Not at all. And if your net consulting income goes over that limit, the government reduces your Social Security benefit by $1 for every $2 you earn above the threshold.
That is brutal. I mean, you could be working incredibly hard to build this new practice, only to watch your guaranteed Social Security check shrink in real time.
It is a huge shock for a lot of people. Now, once you reach your full retirement age, earned income no longer reduces your Social Security benefit.
Okay, well, that's good news.
You can earn as much as you want, but you are still not out of the woods because then you run headfirst into the Medicare cliff.
You are talking about the Medicare IRMAA surcharges.
Yes.
I hear people express a lot of frustration about this, but the mechanics of it seem widely misunderstood. What exactly is this trap?
Well, IRMAA stands for Income-Related Monthly Adjustment Amount. It is essentially a wealth surcharge applied to your Medicare premiums. The government looks at a specific number on your tax return called your Modified Adjusted Gross Income, or MGI.
Can you explain MGI simply for those of us who did not spend our weekends reading tax law? How is it different from just normal income?
Sure. Simply put, your modified adjusted gross income is your total income plus certain tax-exempt items that usually get ignored, like interest from municipal bonds.
Got it.
It is basically the comprehensive number the government uses to decide if you are wealthy enough to pay a premium for your Medicare Part B and Part D coverage.
Okay, so what happens if your consulting business does really well and your MGI goes up?
Well, for 2025, if your MGI exceeds $106,000 for an individual or $212,000 for married couples filing jointly, you trigger the first tier of these surcharges.
And what is the actual financial penalty if you cross that line? Let's use a tangible scenario.
Okay, let's say you are married and your combined household income sits right at $211,000.
So you're safely under the limit.
Right. But in December, you decide to take on one tiny extra consulting project for $2,000. That extra income pushes your MAGI over the $212,000 threshold.
Oh, no.
Yeah. And crossing that line triggers a surcharge that can add over $1,000 to your annual Medicare premiums the following year.
Wait. So you earned $2,000, but it cost you over $1,000 in sudden premium hikes. You basically worked that project for free.
It is actually worse than free.
Ow.
When you factor in the self-employment taxes you also paid on that $2,000, you literally work to lose money.
That is insane.
Because consulting income flows directly to your personal tax return, a highly successful year can inadvertently push you right over this cliff.
So what do I do? Let's say I am following the Retirepreneur blueprint perfectly. It is November, my pipeline is completely full, but I realize I am approaching that Medicare threshold. Do I literally turn clients away and put the brakes on my own success just to appease the IRS?
Absolutely not. You do not halt your success. You start acting like a sophisticated business owner by controlling when the income is recognized.
Oh, interesting.
Yeah, a Federal Reserve survey actually noted that 45% of older employed adults manage their workload specifically to optimize these exact tax and Social Security outcomes.
So how do you structure that without losing the client who wants to start now?
It comes down to contract management. You sign the client in November to lock in the business, but you write the contract so that the project kickoff, and more importantly, the invoice payment, occurs in January the following tax year.
Oh, I see.
Or if it is a massive project, you structure the payments to be spread over 2 different calendar years just to smooth out your taxable income.
You are managing your personal cash flow to optimize your tax position exactly like a corporate finance department would do for a W-2 employee.
Precisely. And the key takeaway from Kurt Rose's material here is that weighing the financial side is just not an option. You need a qualified CPA who deeply understands both self-employment tax law and retirement threshold planning.
Yeah, you cannot just use a basic software for this.
You need them to help you model these scenarios before you send out your very first proposal.
Well, we have covered an incredible amount of strategic ground today. We established why consulting is mathematically the fastest, lowest risk vehicle for your second act.
Definitely.
We explored the paradox of age and how your decades of pattern recognition are exactly what clients will pay a premium for. We broke down the psychology of abandoning that corporate resume, building a precise niche offer, and pricing the outcome rather than your hours.
Which is so liberating once you do it.
It really is. And finally, we detailed the critical mechanics of modeling your income to protect your Social Security and avoid those frustrating Medicare surcharges.
It really is a complete pragmatic blueprint for an incredibly rewarding business. The opportunity is just massive if you structure it correctly.
It truly is. And as we wrap up, I want to leave you, the listener, with a specific challenge. Before you go to sleep tonight, I want you to sit down with a piece of paper and write down just one single sentence.
I love this exercise.
I want you to answer this exact question. Who exactly do I help? And what specific problem do I solve? Do not use your old job title. Do not use corporate jargon.
Right, keep it real.
Be so remarkably specific that your ideal client would recognize themselves instantly. Remember that everything else we discussed today, from value pricing to referral networking to tax modeling, is built entirely on the foundation of that one single sentence. Figure that out, and you have the foundation of a highly profitable business.
I really cannot think of a better starting line.
That's your executive briefing for this week. If you found value in these insights, share this episode with fellow retirepreneurs and subscribe to the Retirepreneur newsletter at retirepreneur.com. Follow us for weekly strategic insights, and remember, your most successful chapter is just beginning. Until next week, keep building.